I'm the CIO managing partner of Alantra EQMC. We run an activist fund with a constructive approach in European small caps. We have, I think, one of the best teams in Europe with one of the largest experience doing active engagement in the space. We run private equity type of portfolio, like 15 name stock, highly concentrated. We have a process to source ideas. We have a process to add value, and those are pretty much the core of what we do. Our philosophy wise, we think like a business owner. We have a very long term approach. We're somewhere between an entrepreneur and a private equity and a traditional business owner when we think about it, but then we add certain layers of value add to our process. If you define small caps as we do, would be typically companies between 200 million to around 2 billion market caps. And you got 1,500, 2,000 companies around in this universe. There's a number of companies we target, which are sectors where we have a particular area, a particular interest. So we would be excluding typical from our universe sectors like financials or real estate or pure commodities for a number of reasons, and then within the remaining, we will be looking for companies which have a sort of a good track record in value creation, good return on capital, attractive growth prospects, and we go through a filter of fundamental due diligence. No, we need to understand the history of those companies, the track record, the product, the modes, the growth, the risks. And it takes us almost 3 months to fully accomplish our due diligence process. It's highly documented, very structured, and that's how we try to avoid value gaps. When you run a concentrated fund, it is very critical that you get comfort there. Once we've gone through that screening process, then we might need up to 2 years to fully size up a position. So we have this concept of seed positions, which is around 1-2% of the total fund. And then over a 2-year period, we will decide to either size up that seed position to what we call core or alternatively sell out. And we only size up 1 every 4. Well, certainly this is a bottom-up approach. And of course, we understand factors, we understand risk, but we certainly construct from a bottom-up perspective. So we have no problem to have it at a particular point of time, a high exposure into a certain area, because we find assets that are attractive. When we think about risk, we think about really corporate risk. Also, we think about the quality of a business, the diversification of the customers, the balance sheet, the structural modes, and we take away typically other elements like volatility of the share price and this type of factors. So these are like balancing checks, but we do fundamentally look bottom up the companies. Of course, we would like to have a portfolio which includes different exposures. So if you look at our portfolio today, we would have a large part of the portfolio exposed to CapEx, so automation, robotics, but we would have some part of the portfolio exposed to non-cyclical areas like perhaps healthcare or food and beverage or sort of a defense exposure. So these things together blend in what we think is an overall portfolio diversification within a concentrated mandate. We've been running this strategy over 20 years. The EQMC fund, I think we've been north of 15 years running it. But if we look at the different vehicles, so over this 20-year period, we've been not only developing this investment team that I highlighted at the beginning, top notch, but we've also been developing a number of senior advisors and external advisors who help us in the different process of our investment. So, for instance, we do have today around 5 senior advisors, which this is pretty much very senior people, which have a partial commitment to us, but we have boots in the ground in pretty much any jurisdiction needed in Europe. These are people coming up from like ex-partners or private equity consultancy firms that they might, join certain boards if needed. They might help us in certain contact sourcing, So it's a little by little thing that we've been created over time. to complement the investment team. So there's a lot of seniority that we have in trusted counterparts throughout Europe, and you construct this little by little over time. In addition to this, we of course have a very ample network of what we call sort of operating partners. A bit of that's more like a private equity concept. These are people who then help us in a certain due diligence to understand better a certain business. So it's a very ample network. People who are like, for a few days a month with us, and then a number of people who are on a project by project basis, and that all together is a very ample network. In Europe, there's a lot of pessimism built in, maybe for a number of well-justified reasons. Europe has been perceived over the last few years as a highly bureaucratic, highly regulated environment, and there's a number of reasons to think that way. But also, the geopolitical developments in recent times, particularly driven by U.S. policy, has shown that Europe is alone in a number of factors. So, that reflection has in a way created the need to be together and to start change. We are seeing things like joint decisions around defense budgets, joint decisions together on trade policy, and Europe is realizing its position and the fact that maybe Europe has a number of drawbacks, but we're acknowledging our position and we are then reacting. It is creating a bit of an inflection point that it is in an environment where over the last few years, growth in Europe has been subdued and pessimism has been high. So the balancing of all these situations creates a bit of a low downside situation, attractive valuation, and that's the landscape. And as a consequence of that, we are starting to see flows from around the world, maybe switching from other jurisdictions. So that is the environment where Europe stands. If you break now Europe into its own constituents, you will see that large caps, it is typically the first part of the market that when you have inflows coming, it will be, filling capacity. And small caps, which is the sector on which we operate, it would typically follows. In long periods of time, small caps have been at a premium to large caps, but for a number of reasons, particularly related to interest rates over the last few years. And we've seen a small caps at a severe discount to large caps. So when you think about Europe, and then when you break down Europe, when you look into the small cap Europe, when we are operating in a space which is where a lot of pessimism has been built. And if you put that together with our strategy, which is looking for global leaders in niche segments, this is a very good, a very attractive hunting ground for us to source opportunities. We are not particularly concerned when you think about investing in Europe about the ability of the companies to evolve, to transform, to expand, or the environment on which they do so. We're actually quite relaxed on that. We're also quite confident on our ability to help the companies through this process. If you ask me what concerns me, I think the macro geopolitical side of the things has been the element. The last few years, and I'm starting with COVID until today, we've seen the economy globally stop. And when you think of and you zoom into Europe, that's been particularly important with these events around Ukraine and so on. Also, that side of the equation has been the main distractor to implement our strategy, because when you have an economy start stop, it's somehow more difficult for companies to engage on longer term perspective. So to us, that external factors have been the deterring factor in last few years, and that would be, to me, if you ask me about what my main concern would be, that would be the element to watch. When we think about what we're particularly excited, I think our portfolio would reflect that excitement. And so if I briefly give you a few highlights on the portfolio, so today, like 35-40% of the portfolio, it is exposed to 3-4 names which are exposed to this sort of automation trends. So we're talking about capex investments in sort of robotics or similar automated process that will substitute manual processes in a number of end markets, from logistics to construction to some industrial processes. And in this particular side, of the portfolio, the last few years, all what has been happening in the world in terms of uncertainty, rates going up, has pushed down investments. So if you look into, for instance, in Europe, GDP of the last few years, you will see that corporate investment has been a negative contributor. No, so we have that part of the portfolio which has been literally smashed. So for the opposite reason, we have a high. We're highly excited about how this part of the portfolio might look in the foreseeable futures. I'm talking the next 5-10 years. No, so this is very attractive. Then there's other parts of the portfolio like aerospace. We have some exposure to the aerospace sector, as you know, in this part of in this industry, particularly because of the problems that Boeing has had producing planes. The reality is people are consuming planes much more than the build rates. No, so we intrinsically see a very attractive opportunity, and we have a number of companies, particularly one of our largest holding, exposed to this sector. We also have a nice exposure in areas like healthcare, where in some areas like vitamin D and some antihistaminics, where we think that has a very attractive structural growth. And of course, we also have some exposure to defense budgets. No, and from the protection side, we have one company called Avon Protection. This is pretty much first responders, police, protection of soldiers. This is pretty much helmets and a mask. Is a protection type of business where we see a strong tailwind from the ongoing budget. So if you look at our portfolio, and these all are in a way opposite risks or different risks. No, so there's a chunk of elements that we are interpreting through our specific investments where we're quite excited about it. And also finally, we have some other elements more on the med tech side, or even in the payment system side, more on the tech side, that we are seeing attractive growth. One beauty of our business model is we have the ability, the team, and the resources and the network to look at Europe as one playing ground. So that would enable us to be highly exposed to the UK if needed, and then move the capital all the way to Switzerland, down to Italy or Southern Europe or Germany. We do have that ability, and that is the core of our strategy. So we are quite flexible. Now we are focused on Western Europe. That means and that is from a governance standpoint. No? So we underwrite Western Europe governance, even though our companies, as I said before, they have global exposure and they have exposure to emerging markets or emerging Europe, but from Western. So that would be the first cut, is Western Europe, where we do invest. And the main reason is governance, not look through exposure. We don't have a particular interest on having all our capital in Western Europe in terms of economic exposure. We want global GDP growth with a Western European sort of governance style. Secondly, when you look about sectors, as I said before, we have certain bias on the positive side, and the bias would be a lot of industrial sort of quality companies with a lot of recurrency, sort of low cyclicity. We have a lot of business to business, a lot of business services, and sort of technology. That would be our bias. Approaching Europe structurally through an active ownership style in the small cap space is an attractive structural way of sourcing alpha, because of the inefficiencies of the market, because there's little coverage, because you can help the companies to move from a small cap to mid cap, and that's what we do. And particularly, you have a sourcing. So we do that in a consistent way, and we've done it over decades. Now, today, in addition to this structural opportunity, there's a bit of there's a bit of a tactical situation, and that has to do with the inefficiency that the market is portraying. We don't have a crystal ball to say the market is going to reverse quickly and so on, because the inefficiency typically lasts over a period of time. No, but we're starting to observe is a bit of flows globally, starting to look up into Europe with a different degree of interest than in the past.